In a world brimming with challenges and change, with crises all around us, we need ideas, innovation, and inspiration. Welcome to the Free Market Roadshow 2024, where the pulse of contemporary discussions beats.
Welcome to the second panel, everybody. Very happy to have Barbara Kolm here with me, the director of the Austrian Economics Center. She has been fighting for freedom for a very long time. The Free Market Roadshow has been going for 17 years, which I think is very impressive. If you look at, how many cities that are hosting these kind of panels. Barbara has also served until recently, September, right, as the deputy chairman of the Austrian Central Bank. I think it's quite rare that you see people with not only from Austria but with an Austrian economics conviction, sitting in those positions, and I think that was most welcome. So what we're going to do in the second channel is we're going to focus on monetary policy. Of course, I don't have to explain to you how important monetary policy is for freedom. If you really want to destroy society, hurt it very badly, and you don't want to carpet bomb it, then there's no better method than to mess up the money supply and to undermine the stability of money. All nasty things can happen when you do that. And sadly, in history, we've seen many examples of that. That does, of course, not stop the expert class from suggesting all kinds of monetary policy experiments, mostly just the recycling of the previous failed experiment. We only have to listen to Goethe back in the 1700s, who was railing against paper money. But what did he know, right? The lessons are always forgotten. So it's incredibly important to try to refresh them to everybody. So without further ado, Barbara, I'll give the word to you.
Well, thank you very much, Peter. And as you all know, Faust, of course, was truly important. And if one should, like Hayek, reread him eventually to come to new ideas and new conclusions. And what I would like to do today is just guide you through a little bit of what we have done wrong and what has happened, and give you some numbers before Peter and I will discuss monetary policy. And I was just at the conference in the United States on monetary policy with former Fed executives and directors and great intellectuals discussing also the difference between the Fed system and the Euro system, the European Central Bank. And we have to admit there is a huge difference, because if they start printing money, it has different effects on the economy as when we do so-called print money and start our QE programs. Nonetheless, on both sides of the pond, and I'm very frank here, the results are bad. And despite probably the ideas that, one should do it or one needs to do it in order to save Europe, and I'm quoting Draghi here or paraphrasing Draghi, I think he just kicked the can down the road. And we did not solve any problems, as a matter of fact, and we have been discussing this on the first panel as well. Doing homework on the nation states, in the nation states, would be a much more important task to fulfill than allowing both Brussels or Frankfurt, or both and Frankfurt, do a job that is probably not in their mandate. And before we talk about or look into details, I just would like to address some points that make the problems and issues even more difficult. And those are the geopolitical and security issues and threats, the technological challenges that we have been addressing in the past panel that Chris brought up with digitalization and all the regulation on that front. And of course, the environmental issues that are coming up. And, I'm a hunter, so I believe in nature, and I love nature. And but you don't have to enforce green policy on people, and it's definitely not in the mandate of the European Central Bank to fulfill green policy and politics. And I think we need to step back on that. And in order to confuse you even more so, I use the slide by Larry Summers when it comes to what are the reasons for inflation and stagflation, and it's just very complicated. And after all, let's go back to Hayek. And Hayek has a very simple explanation. And if you say, the more government is involved, the worse it gets, and the more policies we have, the worse they are. And if we look at the details here, the euro area growth and how it is slowing down, and what were the triggers for inflation. And to be honest with you, of course, the war plays a role, but it was the amount of money, the so-called QE programs, and I will show you some slides later on, that were the first trigger. And when we started the European Stability Mechanism in 2012, 2013, and then started with the API programs, this was actually building up the debt and kicking the can down the road. So this is the first reason for inflation. The second reason for inflation was the so-called Green Deal. What happened in 2018 when it was announced? All of a sudden, energy prices started to rise. What is a price? I mean, everybody who knows logic and economics knew that this would happen if you announce a certain policy. And then, the sparks of inflation were there, 0.5% here and there, not too high, until the next program, COVID, came with the PEP programs and the lockdowns. And if you destroy the supply chains, if you distort supply and demand, what is the logic consequence? Prices won't work, inflation. So you have the third reason. And then the fourth reason, of course, was then this terrible war and the aggression in Ukraine, and then another distortion of energy prices with that. So we have four different reasons. And hitting at one place. And this has never happened, actually. We had one single issue here and there, and if we look back in the 70s, it was a different issue. Many of us still have that in mind, especially in the US, and they fought it in a different way. But the way we did it here was different. So what I also would like to take into consideration when we look into inflation, the war in Israel, of course, will have a consequence in the rise of energy prices as well, and the long-term inflation expectations are on that front relatively stable, but they will be there. In China, we see the weakness in domestic economy, and they coincide with weak external demand, which will also trigger inflation and which will drive prices. And then, of course, and there maybe Chris has something to add on that, the US labor markets that show signs of cooling. Also on the US side, of course, we will see differences before the election and after the election. As we all know, this is always a trigger for the economy. But right now, it is an issue. So, what has the ECB done? The interest rates hiked by 450 basis points so far, and to be honest, in short, too little, too late. There was an opportunity in Europe, which was between 2016, 2017, when Europe had seen signs of growth. But back then, Mario Draghi said no, because, of course, the southern European member states had not done their homework yet. and it was no option to kind of cut the programs. We should have done it back then, and if we had started to rise slowly interest rates back then, we would be in a different position. But let's face it. I mean, interest rates have been low since 2000, and then they went down a negative from 2008 onwards, and we keep forgetting that. And those are, disastrous. Here I have just the numbers for the APP program, the PEP programs, and when we thought back then after the European Stability Mechanism was brought into place, that the APP was bad. If we look at what in short time, within 2 years, what the PEP program has done, and I'm only talking here about what the ECB has done. I'm not talking about the additional programs that have been set up by our nation states, by Brussels, by the Commission, and by other financial institutions. It's just about that. And the consequences of this, of course, is that we will sooner or later have to reduce our balance sheets again. What will be the consequences? We've done this unconventional monetary policy for way too long, actually since 2008. And now we have to go back to normalize. What is normalizing monetary policy? Having interest rates, that refer to the real price of money, and one thing. And second, of course, let the banks do their jobs, lend money and work with money, and invest and finance enterprises. And this has not happened. All those allocations have gone wrong. Here is what the Euro system has done ever since we kind of stopped the PEP program and the APP program. Well, the APP program, and it's just 30 billion per month that we reduce the balance sheet of the ECB. That's actually nothing in contrast to what we have out there. I love this slide especially because it reminds us of what the mandate of the ECB is, and it's definitely not green monetary policy and green finance. So that's none of its business. So we really need to focus on that. And then it's also not the business of the European Central Bank to probably run a digital euro. I mean, there are companies on the market. This is my personal opinion. Don't get me wrong. There are many players on the market who have solutions out there to digitalize the economy also on the monetary front. And I don't think it's a task of a central bank to issue a digital euro. By the way, we have so many different payment methods, and there are many initiatives also out of Brussels that are great, that are working, that are very interesting for the companies, for the private sector. And why should we not allow the individual and the enterprises to choose among which product they want to use, and not the one-size-fits-all thing. And before I stop, I just want to remind you of one issue that has not been risen, and that is also important if we look into inflation, is the decrease of the natural interest rate. And this has been a long history of R-star, and the reasons are lower productivity, population aging, and the excess savings over investments. And I think, and it has been addressed in the last panel already, that the population aging is a huge problem in Europe, plus the lack of productivity. Don't get me wrong, we have countries that are still growing okay, and their economic growth is fine, but like Austria, I mean, we have to revise our data again this month, and we will have so-called growth of 0.4, 0.5%. I mean, this is not growth. and this is not what we need in order to be productive and competitive. But after all, who is Europe competing with? Areas in the world that are, where you have a young population that is eager to work, that is eager to be, to gain, eager to contribute, and to just doesn't stop working on Wednesday because we have done our 20-hour work and we want our, no, I'm provoking a little bit, we want our work-life balance. And I think these are issues that we need to address as Europeans, how the next generation will also contribute in a way that we can outmaneuver the population aging that we see. And then one last point, I already mentioned that the digital euro, I don't think this is a solution to all the problems that we have. Many politicians might think it is. I doubt it, but at least if we need to address inflation, and this is what we will do now, I think this is not the task of the central bank to do it. Okay, this would be my remarks, and I'll hand over to Pieter.
Thank you. Thank you very much, Barbara. Maybe before we go to Q&A, I'll give my presentation, which is overlapping a tiny little bit, but not too much. I'll do something very simple. I'll try to make an overview of all the programs and initiatives that the ECB has engaged in over the years. So I'm going to throw a lot of acronyms at you. So just to give an idea how massive this is, and of course, the very first one is its interest rates policy. So the ECB basically issues loans to banks. I often ask people, so what is the key thing that changes if a country joins the Eurozone? For example, take Bulgaria. Bulgaria has its currency pegged to the euro, and many transactions over there already happen in euro. So some people say, oh, it's not going to be a big change if this country joins the Eurozone. Now, or even take Montenegro, which does not even have its own currency anymore. And then the answer to the big change that will happen when those countries join the euro is that banks based in those countries no longer get a loan from their central bank, but they get a loan from the ECB. So the financial conditions are much looser. They will get a lot more money, hard currency basically, than they could ever had without. And what happens with those resources that those private banks receive from the central banks are typically invested in government paper or real estate or sometimes stocks. So the ECB's policies of low interest rates, trying to manipulate the short-term interest rate, not the long-term, which is also affected by the long-term factors you've mentioned, Barbara. This has been one reason to drive down the interest rates. They probably would have come down anyway, but they came down a lot more, you could argue, I think, thanks to these extraordinary or non-normal monetary policies. And since at least 2014, before, we've seen NIRP, NIRP, negative rates in Europe. This is not only in the Eurozone. Denmark has been quite active with that, but certainly also in the Eurozone. We had a policy called forward guidance, basically communication, central bank communication about the state of the economy, whereby it tries to indicate to market actors what its future policy will be. And the fact that the ECB says, don't worry, we're not going to toughen up too quickly, is already a signal to those investors that this is what they can invest. So even if they don't then actually lower interest rates or do anything, announcing can already have an effect. Then we have the whole the whole asset purchasing program machinery. First of all, quantitative easing started in 2015. If I have that right, with the PSPP, 2,600 billion euro, enormous sums of money. With economists pretending this has not really an effect. It's not entering the real economy. It's okay. Why are you doing it then? 750 billion with the PEPP. This is the pandemic emergency purchasing program. Then second part of asset purchasing, we have the credit easing programs. We have the SMP. I think this was the Stability and Markets Program. A tiny 18 billion I see here. Maybe 218 billion. I cannot even just pocket change as compared to what they've done later. But this was the first one. Very important. Then we have a program that, to my knowledge, has never been activated, the OMT, the Outright Monetary Transactions. It's a program of the ECB whereby the bank makes purchases, outright transactions, in secondary sovereign bond markets. So it's illegal to purchase directly, so they purchase in the secondary market. I would say every serious lawyer should equate this, but that's obviously not what happened. This is all past. There were some serious challenges in Germany at the the top German court, but this was mostly theater. At the end of the day, it was all waved through, then we have going forward the asset-backed securities purchased program, ABSPP, in 2014. Before that, we had the covered bond purchase program, CBPP3, in 2009. In 2016, we had the corporate sector purchase program, CSP, in 2016. So it just never stops. Then thirdly, we had slightly different from asset purchasing, the ECB engaging in subsidized lending programs to banks. Ultimately, all of this had the effect of, suppressing the interest rate, pumping lots of cheap money into the market. So when governments in the Eurozone had to refinance themselves, which means take a new loan to pay back the old loan. You shouldn't try this at home. But this is standard procedures for governments to finance themselves instead of paying back their loans. That's seen as a crazy. So that the whole point of these programs is to pump lots of cheap cash into the markets, which then sort of court economists say, oh, this has zero effect on inflation. It stays in the financial world, and meanwhile you can see, real estate prices go berserk. You can see stocks go berserk, but nothing to be seen here. Anyway, this subsidized lending programs to banks were called LTRO, slightly better known, long-term refinancing operations. A few years later, they started with an even more perfected version, the TLTRO, the targeted long-term refinancing operations. In terms of figures that amounted, you had LTRO, LTRO2, TLTRO3, amounted to 1,000 billion euro. What's 1,000 billion euro between friends? Exceeding the. So this was also a pretty big, effective program. If I got it right, 1 trillion between 2008 to 2020. Interestingly, we had French President Sarkozy very unhelpfully commenting that the point is for banks to pass on this money to sovereigns, to governments. He was not supposed to say that, right? That was obviously the goal, but the politicians didn't really pretend anymore at one point, or at least President Sarkozy did not. Then we're already in half. We have all kinds of promises made by the ECB, the most important one, of course, being the 2012 promise by Mario Draghi for the ECB to do, quote unquote, whatever it takes. He didn't make this in the Eurozone, he made this in the Eurozone's financial center, London, to investors, reassuring them that they don't have to worry too much about lending to countries like Belgium and Italy, and fearing that maybe they are not so well governed, so at one point they may not pay back their debt, because the ECB is there to do whatever it takes and rip off savers to bail out people and investors that take major risks. Then fifth, we have the Target 2 program. To be fair, this should not be seen as on top of all the other stuff, but it's sort of a different way of calculating the exposure. Target 2 is like if you go on a holiday with friends and one person goes to the supermarket, buys everything, and the others only a few small things, and in the end you sort of, you calculate who should pay what. Well, the same happens in the Eurozone. It's Germany that goes to the supermarket, pays for everything. So if at one point we have a problem in Italy or Belgium, and these countries can not longer pay back their debt, then apart from, and then you have another discussion on should Germany and maybe France then fork up some cash to pay for bailout loans, then once again you will have the Target 2 behind it all, with politicians in Italy likely making clear to German politicians, look, friends, of course it's in your right not to pay an emergency loan for us, but don't forget that if we are no longer friends, that you have a massive claim on us, the Target 2 claim, which at one point amounted to 1.1 trillion euro. It has come down a little bit, I think. For Germany, it's still very high. For the Netherlands, for some reason, it's quite low at the moment. So this changes a bit. It's a very important part of the Eurozone debate. And in Germany, you have the senior economist Hans Werner Sinn, who managed to write a bestseller about the Target 2 problem. I mean, it's quite an achievement, the Target Falle, the Target Trap, to manage to write a bestseller about such an obscure but yet very important aspect of the monetary union and its whole monetary bailout machinery. Because apart from that, you have also a fiscal bailout machinery, the ESM and all these emergency schemes, but I won't deal with that here. Then to conclude, there's one more thing, one more monetary bailout transfer mechanism that technically is not implemented by the ECB, but that is implemented by national central banks. And this happened during the Greek crisis, and it is called ELA. ELA stands for Emergency Liquidity Assistance. It basically enables national central banks to print money to fund their private national banks up to a certain level. Greece was very angry that there was a cap to this level, but this is an emergency program. In theory, in the ECB board or governing council, one of the two, a 3/4 majority can block a country from using that. But of course, that didn't happen because this was all political. This reminds actually of the end of the ruble zone. When the Soviet Union collapsed, all these little countries like the Baltic countries, they also used rubles. And one of the reasons for the high inflation at the time was that national central banks were just happily printing and trying to, keep their banks afloat. But at the end of the day, of course, everybody printing, thinking they were ripping off the other, resulted in everybody ripping off everybody, and you had this high inflation figure. So why am I mentioning that? Maybe in a very big crisis, you will see similar things in the Eurozone, where all countries will try to keep their banks afloat by making use of this specific ELA option. But at the end of the day, of course, this will mean in a cost imposed on everybody. So I'll leave it there, and I happily take any questions.
Use this experience to fuel your aspirations. Be part of the change. Let's explore, learn, and grow together. Secure your spot now.